Jason, back on August 2nd, you changed your view from bullish to fairly bearish. If people followed your advice, you saved them a lot of money. You might even have made them some money. Why did you change your view?
We changed our view mainly, Adam, because of the debt ceiling debate in the U.S., which was not only divisive, but divisive and unresolved, which meant that you were looking at another 3 or 4 months of negotiations, which is very worrisome.
It's still kind of unresolved.
It's still very much unresolved. And then also, I think Europe, since that time, has only gotten worse. So, listen, I hope my compatriots are right. I've tried bull markets. I've tried bear markets. I like bull markets better. But I think it's very difficult to get the market to really move higher in terms of risky assets until some of these big secular issues are resolved. And I would think we're close. The
higher we go, the more concerned you get?
Yeah, I would be selling into this and really de-leveraging the portfolio, de-risking the portfolio, because I do think the third quarter earnings might be fine, but the guidance, in my view, is really where risk is for the market.
Talk to me about how high the guidance is and how much it needs to come down.
Well, again, we were going through some of the earnings numbers before. You're looking at S&P 500 profits expectations of $111. We're probably going to do about $95 this year. I mean, that's 15, 16% in a period in which you're looking at 0 to 1% real GDP growth in the States and the possibility of a recession in Europe. Very hard to do that. And China still worried about inflation. So add all those things up, it's hard to get a robust earnings picture.
We only have about 20 seconds. What's a fair multiple to apply on a $95 number?
I've been doing this a long time. Frankly, I have no idea. It should be a lot higher given 2% 10-year Treasury yields, but right now I'm sticking with 12 just because that seems the number, the central tendency around the numbers that people like.
And bottom line, you said you're selling into this rally. You made the comment, you said you'd be selling into this thing. What sectors are most vulnerable right now?
I think in particular it's financials and industrials. I think when you look at where the expectations lie in terms of the greatest increases in earnings next year, those are the two sectors in particular that could be hurt, I think, not only by the Fed's Operation Twist, which is going to obviously flatten the yield curve. I also think the global nature of an economic slowdown would be particularly harmful for industrials.
So for all the talk about value buying, the banks are quote-unquote cheap. You're not buying it.
They're cheap, and there are no two ways about it. They're cheap. But I remember 2008 when the home builders were cheap. I remember when financials were cheap then, and they just kept getting cheaper because it's very hard to know what book value is when you don't even know what the value of risk-free, supposedly risk-free assets are. So I think until I get greater clarity on what the policymakers are up to, I really don't have much of an interest to start bottom fishing in financials.
Now, are there any sectors that you're comfortable buying at the moment?
I would say, if you want to be a little bit further out on the risk curve, it's not a defensive sector, but technology, at least to me, has all the benefits of not really being affected particularly by the credit sector. It has tons of cash, doesn't need a lot of debt, doesn't have a lot of debt, so it could really hang in there. As far as the other defensive sectors, healthcare, telecom, utilities, all the basically high yielding areas, I think, are where you want to be.
And what's interesting, telecom's actually down today. Telephone, Verizon, the high dividend names actually down. They're not participating.
Well, it's a beta. Today's a high beta day, so it makes some sense. But again, I think for the longer term, that's where I'd be playing.
Yeah, sit on your cash. All right, we're about to get into the opening bell, and if you wait about 2 seconds, you're going to hear that bell. I'm going to just turn around. I want to look at the big board right now, and there it is, the Dow. Finishes up on the highs of the day, about 185 points. The S&P up 1.9%, up 21 points at 1165. That's a big deal. It's way above the support. And finally, the NASDAQ comp, Lisa, that finishes up also about 1.9%. The volume is very light, Lisa, but, it's another green day no matter how you slice it.
All right, it's 3 for 3. That's a nice way to almost end the week. We, of course, have one more day. So who knows? Anything can happen. Well, Jason, let me ask you a couple questions. Let's get back to fixed income for just a moment. You said it's hard to sort of not stay long at this stage. Where do you expect the 10-year to be in a year from now or even at the end of this year?
Listen, I think one of the concepts I've embraced quite a bit is the concept of financial repression that was talked about by Carmen Reinhart. I think given the fact that so much of the U.S.'s debt is short-term, 60% of it matures in the next 3 years, in some ways interest rates can't go up, long-term interest rates. And I think by hook or by crook, interest rates are going to stay low for a very long period of time, almost regardless of what inflation is. So I've kind of been burned by being short bonds, and my own particular feeling is I'd rather not be short bonds. I have a feeling they'll be very close. The yields on 10 years will be very close to where they are today a year from now.
venture into any area of the credit markets at this point?
Well, I do think the idea of high-quality corporates. I also think even some parts of high yield could be very, very interesting, because I do think one of the things we've been saying is you want to look for stocks that look like bonds and bonds that look a little bit more like stocks. The idea that you're in a yield-hungry world, a world in which Mexico can issue 100-year paper at 6%, there's a lot of bid for high-quality interest, cash flow streams that you can rely on.
Do you go with some of the other sovereigns, maybe it's Canada, or do you stick with, say, a solid American Philip Morris and buy their bonds? What do you like?
Adam, we counted in early August, we counted 54 companies that actually had credit default swap spreads lower than the credit default swap spreads of the U.S. government. And so in some ways, we're calling them...
In other words, less risk. The market's perceiving less risk.
And so in some ways, I think there are a lot of companies in the United States in particular that, frankly, are a lot like the new sovereigns. They're going to be proxies for what was previously seen as unassailable sovereign credit. And I think, as we can see now, it's pretty assailable. I don't even know if that's a word, but
it sounds good to me.
It sounds good around the world. And there's a lot of companies, whether it's Philip Morris, whether it's Bristol Myers, Johnson & Johnson, there's a lot of Microsoft, a lot of companies that are fortresses and, frankly, have better credit risks, according to the market, than sovereign credits.
And when you say fortresses, you're talking earnings growth as well as a fortress balance sheet with cash.
Exactly. So these guys you can almost take it to the bank that you're going to get paid either from a dividend or the interest payments will be made.
Corporate bonds may be the place to go, in other words. Lisa?
All right. Thanks so much, guys. Well, of course, a lot of companies sitting on cash because they are waiting to see what happens with the economy, and investors are waiting for tomorrow's employment numbers. The latest report after an August with 0 jobs added. David Resler is chief economic advisor at Nomura Securities. He's the top economist on payrolls, according to data compiled by Bloomberg. That's why he's a Bloomberg best. David, welcome to Street Smart. Great to have you on. What are your expectations for the employment figures tomorrow?
We think the headline number is going to be 60,000 increase in non-farm payrolls, and it's going to underpinning that will be an 80,000 increase in private sector payrolls. It's not all that exciting, given that we pick up about 45,000 workers who weren't counted last month because they were on strike. So the underlying picture in the jobs market is still pretty weak, but one that's not indicating the economy's in any sort of decline.
You are, however, slightly more optimistic than the consensus, which is looking for an increase of 54,000 in payrolls. Anything that you saw in the spate of data released this week that suggests there might be perhaps some upside to the number that we see tomorrow?
Not really. I mean, when we factor in the data from the two ISM reports and the jobless claims data are post or after the employment survey week, so that didn't really affect things. But when we factor in those two ISM reports, as well as some other recent indicators, we are still getting numbers that are in the neighborhood of 70 to 80,000 payroll increase. So we feel reasonably confident about that increase in private sector payrolls of about 80,000. Government jobs is a little bit more of a wild card. This is a month in which you could pick up some government jobs, but frankly, with Hurricane Irene having disrupted activity in the Northeast, it could be that some government jobs got lost along the way.
Jason, you made the comment that we are just one bad jobs report away from QE3.
Well, listen, I think Chairman Bernanke has been very clear that if you have a choice between inflation and deflation, you always kind of go with inflation. I do think right now, if you look at core inflation, it's up to 2. CPI is 3.8 year over year. It's going to be hard for the Fed to ease unless you get further declines, I think, big declines in payroll or further declines in asset prices. I have a feeling what will probably come first are further declines in asset prices before you get the big declines in employment. Employment is growing, albeit at a slow level. But certainly, I don't think QE3 is off the table by any means. It may be off the table for right now, but if you get more weakness in the market like you got in August and September, it could be back on the table quicker than you think.
Hey, David, you just heard Jason's comments. What's your view on GDP and the possibility of another QE3?
Well, I think Jason's right. It's going to depend upon how the economic data unfold and how the financial markets behave in the next few months. We still haven't resolved the crisis in Europe. We're making steps in that direction, and that could provide some calm to the markets over the months ahead. But until that's really put to rest, I think we're going to be vulnerable to that kind of setback. Having said that, we're still looking for a second-half growth in GDP that's about 3 times as fast as it was in the first half. Now, that's not saying a lot. First half, we grew at about 0.8% annual rate. Second half, we think will be about 2.5% annual rate. So, and frankly, the data throughout the third quarter is supportive of that view.
Well, David, Jason, again, I'm going to ask you the question Adam asked me before, which is if Europe goes into recession, can the U.S. avoid one in 2012?
Yes. The answer is yes. The U.S. can avoid a recession if the only thing that happens is that Europe falls into recession. But if the reasons that Europe falls into recession is that there's a financial crisis in Europe that brings down some large banks, it's going to be more difficult for the U.S. to survive that kind of setback.
Here was a question that was put to Jason earlier, David, but what happens with the president's job bill should it get passed? As he was saying today, do you think it could actually mean that we can avoid a recession? Would it significantly impact the unemployment rate?
Well, the president said today that he thought it would generate about 1.8 or 1.9 million jobs. I don't know over what time frame he was referring to, but that's an estimate that's consistent with how macroeconomists would analyze the economic impact of the jobs bill. The problem is that it's a temporary act that we have to pay for later somewhere down the road. And the recognition that we have to pay for it may inhibit some of that job growth that would otherwise come from a tax cut of the magnitude that's being proposed. And
momentary aside here, I do want to take a question that I got via email from one of our viewers to Jason. Jason, you know, earlier we were talking about credit markets. What do you think about Bank of America, Morgan Stanley, and Goldman Sachs bonds? It's coming from one of our viewers.
They're bonds? Or?
Yes, as credit, as a potential investment.
Listen, I think it's, you know, my own view is it's too rich for my blood personally. I think if you're a professional, it could be very interesting. But I think for a retail investor, I think there are other kind of higher quality or less onerous or less volatile things to look at. I'm quite worried. One of the things I'm really most worried about is that you might need more financial pain, more pain in the financial sector to get the secular changes from policymakers you need to resolve these issues. So I think until you see that, I would be quite careful.
All right, Jason Trennert, founder of Strategas Partners. Thanks for joining us. It's great to have you here. David Resler of Nomura Securities. Thank you as well.